Tryphosa, thanks so much for your time as always. Yet another CEO. Wow. What is it about the hot seat there at PPC that people don't stay?
I know, I can't comment on that. I think it is his wish that he wanted to retire early. Obviously, he's turning 60 and he's been with the company for more than 30 years. So it's a personal choice.
Right. So he did say that, I mean, for the past 18 months, it's been hard work, ensuring that the turnaround that, you know, some might argue was even started by his predecessor, Johan Claassen was seen to fruition, because your numbers show that you are on a much better footing, although there are still pressures that are persisting, particularly here in your home market. You're talking about the difficult trading conditions locally, and for me, if we fast forward to this infrastructure fund and this infrastructure plan that government has outlined and announced, could this be the saving grace for South Africa's largest cement company?
Not in the short term. In the long term, the infrastructure fund could assist. Because, as you are aware, most of the construction companies are in trouble because of the trading environment, but also because of their balance sheets as well. Their balance sheets are not looking great. So for long term, that will be good for South Africa in the infrastructure space. The difficulty now is that you've got the economy which is shrinking. The Reserve Bank governor announced that 2018 is been reduced from 0.7% to 0.6%. We are geared to the growth in the economy as a PPC in South Africa. And then if the economy ticks up, then we will be able to benefit from that. So if next year the growth is the way they forecast it, that will improve from the volume point of view. But the challenge is that you've got many players. The demand is around 14, 15 million tons. And then you've got 18 million tons of capacity. And the imports are getting into the country. So the imports...
But how? Hasn't government protected the industry from that?
They've only protected against the Pakistani, okay? Because they were dumping. But now you are getting imports from all over, from China, from Pakistan, from Venezuela. So you're getting imports that are coming all over through the port of Durban. And some are going into the Western Cape as well. But many countries in the SADC region, because infrastructure is so important, you've got overcapacity. It's about time we engage with the government for them to protect this industry, because this industry is going to collapse if nothing is being done. You can't just open your borders for anybody to come into the market. The prices have been going down 25% in real terms for the last 5 years. So as a result of that, we have not been able to pass the price increases to the consumers. But our input costs have been increasing. Salaries are increasing, electricity bill is increasing, coal prices increasing, oil prices increasing, the fuel prices increasing. So, and we are a capital-intensive business. We need to maintain our plants. But you can't allow people that are manufacturing at very low prices, that are not employing any of your people in the country, to just come and dump the cement.
But then is this cement coming in the country legally? And
it's coming legally. They got all the approvals. The key is that the industry needs to engage with the government.
Right, because you've also got a situation right now where any form of building that is taking place, as you say, is taking place with the pressures from costs. So you've got these guys who are importing and are trying to limit their costs by sourcing out cheaper cement. So my question to you is efficiencies from PPC side to compete?
We are more efficient as a company. We are the only one which is national. We do optimal sourcing. So what happens is that a customer that is national, when they buy from us, we check as to where can we deliver from which plant. And then you reduce the logistical cost and doesn't pay a different price in that aspect. So from an optimal sourcing point of view, we've done. So we introduced what we call 50 Rand per ton profit improvement program, whereby we focus on reducing the cost. So today, as we reported, we achieved 22 Rands per ton. We are halfway towards achieving what we said we are going to achieve. And we increased the target to 70 Rands. So over the past 5 years, as I said, the prices have gone down 25%. Costs have gone down in real terms 15%. Okay? from the efficiencies point of view, we are actually having a 3-plant mega strategy whereby we are sourcing from 3 mega plants. But this year we also had a problem in one of our plants whereby we had some unplanned shutdowns due to some, one of our gearbox has just blown out. And then from there we had to put the plant down so we could not produce. And that every day you are not producing in a plant, it's a cost.
Sure.
Because of labor, you've got, you have to pay for the fixed cost. So as a result of that, these results have been impacted by that. Around 1% of the EBITDA margin is from that unplanned sort of shutdown in the plant. But as I said, from an efficiency point of view, if your prices have been down 25, your costs have been down by 15%, from an efficiency point of view, despite inflation going up, that means your margins are being squeezed.
All right, so we'll certainly look at you guys' developments with government regarding more protection on the industry. But just as we wrap up, I mean, your rest of Africa operations are continuing to provide some form of a buffer for Miagro growth here at home. Zimbabwe, many people still cautious about Zimbabwe, but I see you still growing revenues quite strongly there. I mean, take us through what's going on the ground there in Zimbabwe, your outlook, and also just Ethiopia. I mean, how soon before we see things really starting to take up there?
Zimbabwe is doing extremely well. There's a shortage of cement in the country. We actually had to import some of the clinker to grind it in Zimbabwe from South Africa, from one of our plants, okay? Because on the ground, people are investing in their homes, in tangible assets because of the liquidity situation. Liquidity meaning that they are unable to take money out of Zimbabwe. So as a result of that, money is sitting in the bank account, but you can't take it out at the ATM. So you're doing things through EFTs. So in that aspect, people are investing now into tangible asset, which is property. But the government as well is investing in infrastructure. There's some money that is coming from the Chinese. The projects that are happening on the ground, it's roads. We are supplying the Guaishangan Dam. We're supplying the Victoria Falls Airport that is being upgraded. We're supplying the American Embassy that is being built in Zimbabwe. So we are having all of those that are happening despite the chaos that is happening on the ground. And with that, we are the biggest producer in Zimbabwe, but we've run out of capacity from a clinker point of view. We are full capacity from a clinker point of view. Hence, you saw Zimbabwe, in terms of our numbers, contributed more than 300 million rands.
Sure.
And then Ethiopia, we are not controlling in Ethiopia. We are having just challenges on the ground in terms of the plant to operate to its design capacity, but the demand is there.
Sure.
What we are producing, everything that we are producing, we are selling. And we are even on a backlog because customers, since they paid us 3 months ago, we are actually producing to make good in terms of the orders that we have received 3 months ago. The only challenge is that our plant is not operating to its design capacity. And also we're in a region whereby it's a little bit, there's unrest in the region whereby it affects from our efficiency point of view. But over time, Ethiopia is going to surprise us as similar to what Zimbabwe is actually doing. The only challenge in Zimbabwe is the liquidity. And the DRC also contributed for the first time, 60 million rands into the EBITDA compared to in the past whereby we're still building. So we are saying position-wise, we are well positioned. We are ready. When the economies improve, we are going to take that improvement. And Rwanda as well is doing very well. We also were upgrading the plant because it was also not performing to its design capacity. We're going to run out of capacity by 2019 in Rwanda. We are supplying the Bugasari airport, and we are the only producer in Rwanda, and we are the leader from a market share point of view. So the rest of Africa is not the wrong decision that we made a few years ago. So it's the decisions that we made, it impacted on our balance sheet from a gearing point of view because we had to go to the shareholders to get money from the shareholders because we were overgeared while we were building these plants. But now we are seeing the fruits of that investment. While South Africa now is still struggling, but then we are seeing from the other countries, we are seeing the benefits that are coming. We call it a portfolio effect, whereby from a portfolio management point of view, the other one that is not doing well, the other one does well. Then you are shielded. That is why you see our headline earnings per share is up 11%.
Diversifying your earnings
despite the tough environment that we are in.
Your biggest market.
Yes.
But Tryphosa will have to leave it there. That was a PPC CFO, Tryphosa Ramano.